A doom loop is imminent as cracks are forming in the credit markets. I'm your host, Steven Van Metre, and thanks for joining me today. And while investors are eagerly buying every dip in stocks, cracks are beginning to form in the credit markets, threatening to unleash a massive doom loop and send stock prices lower. Let's pick this story up where we head over to Bloomberg, who headlines the JP Morgan strategists say buy the stocks as rate hikes are now priced in. And I want you to understand why everyone is so eager to buy stocks, because they're being told to. And the equity cycle is far from over, according to JP Morgan's Maxia writes. Neither the Federal Reserve nor European Central Bank will move further into hawkish territory, or at least relative to what is pricing currently, strategists led by Maxia wrote in a note on Monday. Meanwhile, headline inflation is peaking and earnings are likely to surprise positively. We believe that equities still offer upside and the cycle is far from over, they said. And yes, there is some historical truth to that, because when the Fed raises the federal funds rate, as you can see here in blue, and as I've crudely drawn in red this box, you can see equity prices still rise as the Wilshire 5000 rises in each of these events. So there is evidence to suggest that perhaps there's more equity strength ahead. There's one thing they're missing, and that is that this last expansion had everything to do with fiscal stimulus, and that's gone. But let's keep going with the story, because we think it is wrong to position for a recession. Given extremely favorable financing conditions, very strong labor markets, strong corporate cash flows, and the likely bottoming of economic growth in China, according to JP Morgan's team. Well, let's take a look, because JP Morgan, I think the one thing you're missing is a real disposable personal income is negative or about zero on a year-over-year rate of change. And we can look and see that while it hasn't triggered a recession currently, mainly due to fiscal stimulus still being in consumer bank accounts, we can see back in 2015 it almost triggered a global recession. In 2008 and 9, it was part of a great financial crisis as disposable income went down. Well, we saw a recession here. We saw the dot-com bubble as disposable income went down. And we see that recessions are generally marked by periods where consumers cannot afford higher prices. And that ultimately leads to a recession. But let's keep going. Because what we see is, by contrast, Morgan Stanley's chief equity strategist, Michael Wilson, today reiterated that, quote, winter is here for stocks. Oh, that doesn't sound good. He said earnings risk is increasing for a wider swath of the market than most investors expect as rising inventories meet waning demand. Strategists led by Wilson wrote in a note, they listened to the earnings disappointments of pandemic market darlings, included Netflix, PayPal, and Facebook, owner Meta Platforms, as examples of payback for last year's overconsumption. But, well, is it really an issue of overconsumption, or was it an issue of overstimulus? And the answer is yes, retail inventories are rising, and at a really rapid rate. And you might be saying, well, wait a minute, the things I want to buy, I can't get. Well, don't worry. The things you don't want to buy are stacking up quick, as we can see here from this Bloomberg chart, where retail inventories on a seasonally adjusted month-over-month change, well, they're skyrocketing, and that is ominous as consumers have less money to spend as their incomes are not keeping up with inflation. While Wilson recommends investors position defensively for more downside, JP Morgan's team says investors should follow the opposite strategy with underweight position on traditional defensive sectors such as real estate, consumer staples, healthcare, and stocks. And if you're looking for a strategy that positions ahead of these type of events, well, be sure to check out Portfolio Shield. It was designed to hedge against major events like markets becoming volatile or bear markets. There's a link up in the corner and one in the description below. You'll be glad you did. All right, let's continue on, because now we see this headline: the Treasuries join the world bond rout on prospects of supersized hikes. And of course, nothing worse than having a bond rout too. And what you can see is in the ups and downs, we see surging rate hike bets, see government bonds slump the most since 2016. Well, they slumped in 2016 and then 2018. Now the question is, what happened next? Well, in 2016, they slumped here and went on to rally. And in 2018, they slumped again and went on a mega rally, suggesting that perhaps these analysts that are saying it's time to dump bonds, well, they've got it wrong. You want to buy the most when you're the contrarian, when everyone is selling. Let's continue with the story as the market's been hit by a triple whammy: a hawkish Bank of England, a hawkish European Central Bank, and a monster payrolls report, said Andrew Ticehurst, a strategist at Nomura Holdings in Sydney. The message is we're in a bear market for G10 rates, and investors may look to sell the strength. Well, Andrew, according to the last chart, it doesn't suggest that at all, because what we may be facing is a doom loop when the credit markets are suggesting that. Let's head over to Zero Hedge, who headlines that we don't see that very often as credit market cracks could spark doom loop with stocks. And what they point out in their charts, which are by far better than mine, is you see the S&P 500 rising and high yield bonds or junk bonds falling. And now what that's telling you is a junk bond is a bond issued by a company that pays a higher than average interest rate because they don't have as good of credit. And of course, those bonds are riskier. And so when junk bonds start to sell off, what is it telling you as an investor? That the market is losing confidence in those companies and their future ability either to pay the interest or off their debt when it comes due. And so when you see junk bonds start to go down, well, has an ominous sign for where the equity markets are headed. Let's continue on because we see in this next chart, or let's go back to the chart from before and what happened going into 2015. Well, we almost had a massive recession if it wasn't for China bailing the world out with a massive flow of credit. And then we see it again here in early 2018. The divergence as high yield bonds start to sell off out of the equity market. Well, you might remember what happened at the end of 2018, and that was a big crash in equity prices. And what are we starting to see now? As I mentioned, my chart's not being quite as good. And you can see here in the green and red, the HY or high yield bond ETF heading down, and up here in purple, Dr. Purple circle is the S&P 500, suggesting that as junk bonds go down in price, well, stocks will follow. All of which sets up a rather ominous potential for a doom loop of cross asset class driven vicious selling, as credit's current signal impels the marginal stockholders sell in an increasingly illiquid stock market, which given the current amounts of debt will lead to an accelerating sell-off in credit as spreads adjust for equity asset values that are considerably lower than the Fed balance sheet inflated state of nirvana for which they're still currently priced, says Zero Hedge. And once credit starts to accelerate lower in price, well, it can get ugly fast on the other side of the balance sheet. And sure enough, there is no liquidity. There is one thing that Zero Hedge has spot on in that piece, and that is there's about as little liquidity in the equity market as we see here. The market depth proxy for S&P 500 E-mini futures, the average number of contracts on the bid-ask in S&P 500 E-mini futures shown here in blue, and the fewer you see, well, that means there's no liquidity. And right now, markets are about as illiquid as they were at the depths of the pandemic, suggesting if there is a massive bout of selling that causes stock prices to fall, well, they could plunge really quick and send volatility higher. Let's keep going with the story because Zero Hedge continues, which would only stop as it did on a dime in 2020 if the Fed stepped back in and put the world's risk takers back on the shoulders. But remember, they've got an inflation mandate, and as I said, they're probably not coming back to the table until inflation cools. And one way to get inflation down, and the Fed knows this, is to see stock prices go down, because when stock prices go down, as we've talked about, demand goes down. Let's continue as the bear market. And bear in mind that if the credit is correctly anticipating an increase in equity volatility to a VIX around 40 currently, which I think could go a lot higher, we're talking about the S&P dropping around 4,100. Of course, there is, however, a potential silver lining or throttle on this potential waterfall, and I'm not so sure there is because we've talked about this chart here, which is the VIX in red and green, and this band here between, say, roughly 30 and 36, and if it breaks out up here to 40, well, that means stock prices are coming down. As you can see, when the VIX starts to spike, it lines up very well with that. But the other problem is you have all of these volatility controlled products that start to unravel, and they are mechanically programmed by their formulas to start to sell equities as volatility rises. And if they have to sell into an illiquid market, well, that will only send volatility even higher, stock prices lower. And since bond prices fall, stock prices higher, well, it means that interest rates are also going to collapse, which brings up the next part of our story here is the interest rate market. As many people wonder, are we in a secular rise in interest rates, or are we at perhaps a turning point for the bond market as yields are more likely to go down than up? Well, what I've got on this chart is everything from 2, 3, 5, 7, 10, and 30, omitting 20s because there just isn't enough history to matter on them. And what you see in these inflection points where they all start to come together, I want you to notice what happens to yields as they start to go down afterwards. And that is really important. Another thing to note is the correlation between these broke in the 80s. You could start to see that, and by the 90s it's very obvious that long-term yields are not following short-term yields. But what does it mean when you see short-term yields start to approach the same rate as long-term yields? And it means that short-term growth and inflation expectations are the same as long-term growth and inflation expectations. And that should never be. In fact, future growth and inflation expectations should always be greater than current expectations. And so when you see them meeting at the same point, well, it's bad news because it's telling you that future growth expectations are terrible. So let's take a look at what this means. If we can look back at the great financial crisis and we can see where all these different yields in the curve started to come together. And what did it do? It told us the financial conditions were indeed tightening and sparked the great financial crisis. And here you can see where we're at currently. And note, back in late 2018, they started to come together again and ahead. Again, this happened well before the pandemic. You saw yields start to sell off. And what's happening now is the front end of the curve, those 2s and 3s and 5s are starting to accelerate right up to the 30s. And that's telling you, as those get closer and closer together, well, what is the likely outcome? Well, that's really easy to see because on the next chart, we went back to the original one and I just drew some arrows just to give you an idea what happens when you see yields across the curve start to converge. Well, it tells you again that financial conditions are tightening and that yields are more likely to go down than up. So concerns that people have that we're in a secular rise in interest rates, well, it all has to do with the design of our monetary system, which prevents that. It also has to deal with the fact that if volatility starts to spike, you'll have a ton of buyers coming into the treasury market. And throughout history, when you see growth and inflation expectations across the curve start to come together, well, it tells you that we're headed into a recession, and that means yields are crashing. Or the most likely outcome is that yields are going to head much lower and crash and bring the equity market and the economy down with them. I'm your host, Steven Van Metre. Thanks for joining me. I'll see you back soon. Bye now. The content of this video is provides educational information only. It's not intended to provide investment advice. You don't have to be construed as recognition or solicitation to buy or sell any security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video do not affect the Atlas Financial Advice Inc. or Steven Van Metre Financial.